as a passive investor, you don't have to worry about any of that. You're basically investing with a sponsor or an operator who is doing everything from A to Z, from sourcing the deal to acquiring it to operating it and then selling it.
Are you frustrated watching your hard-earned money ride the knee-jerking Wall Street roller coaster? Are you looking to diversify into alternate investments and set them on autopilot to achieve financial freedom? It's time to learn the ways of the wealthy. It's time to think outside the stocks with your host, Madhvi Jain, an immigrant from India and ex-IT professional who will bring you industry experts to illustrate a passive and holistic financial approach to build not just passive income, but also your generational wealth. Madhvi is on a mission to change the financial trajectory of one family at a time and 1,000 more to go. Are you going to be part of this vision? And now, without further ado, here is the host of Think Outside the Stocks, Madhvi Jain.
Before we go ahead, just a little bit 2 cents from my lawyer that this is information and education purpose only. If you want to engage with any of our guests, including Shauna, please do your own due diligence. And I am not particularly a financial, legal, or tax advisor or investment advisor. So please seek your own team, and maybe Shauna would be one of that team members, right? And also we'll have some examples for education and information purpose only. So keep that in mind. These are point in time. These are not representative of any real information. Hey, welcome back to Think Outside the Stocks with your host, Madhvi Jain. And we have an interesting question to be answered today with an interesting guest. Zach Haptonstall is here from Rise 48. Welcome, Zach, to Think Outside the Stocks. I'm very excited about this.
Yeah, thanks so much, Madhvi. Really excited to be here. Thanks for having us on. Looking forward to it.
Thank you so much. And the important question that we're going to answer is I get asked quite often that, hey, Madhvi, I'm in Austin, right? Do you have any deals in Austin that we can invest in? And I often tell them, well, if you are looking to invest city around you, multifamily syndication is probably not the right thing for you because there are so many things that go behind that question, right? And, with Zach and his expertise, we are going to answer that question in a very, very detailed manner. So tune into it. Before we go ahead, of course, Zach has a tremendous expertise, and this is the reason why he's here, because they come with tremendous experience. Rise 48 in last 5 years has built a tremendous portfolios, and Zach, amazing. Congratulations for this success. It's 2.2 billion in transaction, 53 deals that you have closed, and 11 deals are full cycle as well. And with that, with 10,000 plus units and $1.8 billion current portfolio, this is the expertise Zach is bringing to answer that one simple question for you today. So Zach, again, congratulations on this feat. This is quite a bit in this 5-year span.
No, thanks so much, Madhvi. We were fortunate to kind of, ride the momentum and keep it growing, and send me the invoice. I'll make sure I pay you well for calling me next. Thank you. But thanks so much. I appreciate it.
I love that modesty, Zach. I think, truly, we love what you do. We spoke to Bikran some time back, and we love what you do. And again, when it comes to syndication, multifamily, you got to really have a thick skin, and we will talk about that why. So, but before you go ahead, it's a drill. You know that I like to talk about 3 fun facts about my guests, and the 3 fun facts about Zach here is that you can see this massive real estate portfolio. But before that, Zach was actually was a sports journalist. He was a TV anchor in Fox Sports, right? So that's one fun fact. The second fun fact after that, I think it's kind of a serial entrepreneur bug, Zach. He was actually into healthcare, which is again completely different tangent, and specifically hospice. So that's an interesting background, Zach, as well. And the third fun fact, and this, Zach, is my most fun favorite fact about you, is that you are a new dad. Welcome to the group of parenting. This is incredible.
You're walking in, Madhvi. Yeah, we've got a little 3-month-year-old baby boy, so we're super excited about that. So it's been really fun.
Oh, that's amazing. It's I know it could be sleepless night, but there's just so much love. I think being a parent just teaches you how to just love. You kind of think that you know how to love, but this is that unconditional love. So how is the new parenting treating you?
It's been great. It's been great. I'm making sure I'm spending time with little Mav in the morning and at night. And so my wife has been great. She's full time, stay at home, taking care of him. So I think we've got our roles, well designated here, and we're able to spend a lot of quality time. So it's been a ton of fun. But it's going by fast. Like when we first had him, everybody was like, "Hey, it's gonna go by so fast." And we're like, "Yeah, I know. Everybody's told me that." But now I get it because they're only a baby for so long, right? And
Yeah,
and when
yeah.
you have your first one, you figure, "Oh, he'll be a baby a while, and I'll have more." But we are trying to really, enjoy the time because it's like you blink and it's 3 months now, and he's already changing. So it's pretty cool.
Oh, well, I spot on, Zach. I blinked, and my daughter is about to be graduate. I mean, she's a senior in
Yeah,
UT Austin here. So that's just a blink. That's how quickly it
everybody
happens,
says, right? It flies by. So yeah, we
It
would
does. It
favor
does.
it.
So hold on to that time. It's so precious, right?
Yeah.
So with that, let's jump into our today's questions. Is city around me a right market for me to invest, right? And Zach, we are talking to passive investors. These are probably W-2 professionals, tech professionals, consulting, doctors, engineers, and when they quite often come back to me and say that, Matthew, do you have any investments coming up here in Austin or whatever that market that they are into, right? The city around you or in New Jersey or something. And I may quite often try to answer that we are looking for emerging market. We are looking for something more than that, right? So single family home, it's very simple. You look around, what that house price is, what that rent is going to be, and what is that you need to look for to get that income and property taxes and insurance. So simple, right? So you don't have to look at too many data and parameters. And that's why, this industry in commercial real estate is more of a professionals. A high expertise is needed. So let's talk about, why they should think about little bit bigger terms than just city around them. What is important when you look at, this 53 deals? Wow, that's amazing. What is it that goes behind getting to those 53 deals?
Yeah, it's a great point, Maud, because I think, when you're thinking of just, investing yourself, you want to buy a single family home, you're probably thinking, I'm going to manage this home myself. It needs to be close to me so that I can go visit it. And regardless of where you live, you might think that that is a good strategy, right? You need to go buy a house in your market. But to your point, you really want to look at different fundamentals. So we're looking at, multifamily apartments, large apartment buildings, at least 100, to 300 plus units. We're looking at a few major fundamentals. And so, one of the first ones, Madhvi, is job growth. We want to be in large markets. And again, this is our criteria at Rise 48. So this is what has been successful for us, and I think a lot of investors. So I mean, everybody can have their own perspective there, but you want to have job growth. You want to have large companies and several companies that are moving to that market and providing jobs, because basically for these investments to perform well, you need people to rent your apartment, and they need to have money. They need to have a job, and so that they go to work, they get paid, they pay the rent, and that rent goes through to you as an investor as cash flow. And you want to have diversified jobs. We're looking at markets. We don't want the employment base to be too heavily concentrated in any one industry. Okay, so we want diversified employment. So job growth is number one. Population growth, is a second, massive category we look at. We want to make sure there's people moving there. Okay, that we're focused on the markets that are leaders in the country for new in-migration. There's more people moving there than aren't moving there, because it comes down to basic supply and demand, right? You want to make sure that there's more people moving there and there's more demand for the housing than they have supply. And so those are two really big ones. A third one for us, Madhvi, is we're focused on landlord-friendly markets. And what does that mean? It means that if the tenant or the resident is not paying their rent, that I can evict them in 30 to 40 days. Okay. And we always
Right.
want to make sure, and we do make sure that, we are doing right by the resident. We're building a strong community. And that's
True.
really why we've been successful. But at the end of the day, and at Rise 48, we are an investment company. Okay. And we have a fiduciary responsibility to our investors to protect and grow their money. Okay. And grow their wealth. And so if I have an apartment building and there's a resident or a tenant not paying the rent, I need to get them out of there. I need to be able to evict them. And you hear these horror stories of some of these markets, certain areas in California, Oregon, Washington State, New York, New Jersey, some of these areas where, people can't evict tenants for 6 months or more. and that is very detrimental to the investment, okay? Because the expenses don't go away, okay? The expenses are still there, but if I don't have that income, I need to be able to get them out. So that's another big one too. So we've focused specifically in Phoenix, Arizona, Dallas, Texas, and Charlotte, North Carolina, because those three markets are leaders in all those categories that we look for.
I love that answer, Zach. There are so many factors that go behind it. And what you alluded to is just scratching the surface. And you and me know that when we do our due diligence about the market and market selection, and not just the cities, but the sub-market that the property in, is that ton of things that go behind it. But listeners, this is at least the least that you can see in the market, right? And Zach, specifically when you talk about being landlord friendly, right? That's so important. Those California markets have had stories about paying your tenants about 15 to 20,000 just to vacate that apartment, right? So where is that cost going to be? That burden is going to be on the business. If they don't pay the rent, that rent loss, where is that burden going to go? That burden is going to come back on the business and back to the investor. So this factor, I mean, I hope it answers your question that, should I invest in market around me, with, especially if you are in New Jersey or, Washington or some of these areas, right? That's really important. One small decision can really slide the scale of this business investment for you. So keep that in mind, right? With that, Zach, I'm going to go on your next question, right? So often, again, thinking of passive investors, when they compare single family versus multifamily, they look at everything, all the advantages that, the syndication brings in, the expertise that the, syndication team like you guys have with, this tremendous portfolio. They also look at that, okay, all the statistical parameters are being measured, this, that. But when it comes to that final decision, right, that the emotion that drives that decision versus rational, and that's again an emotion, right, that I need to invest around my city. So that's number one emotion. But the second emotion is that, hey, when I have single family home, I have control, right? And that
Yeah,
control is something that they don't want to let go, right? So let's talk about this control that,
right.
as an expert, the passive investors, there are hundreds of passive investors in one investment. So one person demanding control, and if the other 99 investors do not have that experience or expertise, do you want the other person to have that control too, right? So that's a big question. The question when it comes down to your expertise, right? Why the syndication team are placed in a right way to be that expert, to make that decision, to have that control. Let's start talking about that what does it take to be a syndicator? So let's start with the acquisition, right?
Yeah.
When they see, for example, the single family deals on the market, MLS listings, etc., right? Let's talk about sourcing. And as a CEO and, the relationship with broker and as well as investors, you play that key role in Rise 48. So tell us, what does it take to have this relationship, get these deals off market and acquisition kind of a process?
Yeah, great question, Madhvi. So like in this space, a lot of people don't realize until you actually get into it. I mean, even a lot of passive investors don't realize it now. That we have probably a ton of investors that don't understand how this works because they're passive, right? But in this commercial multifamily space, there are literally 5 to 7 real estate brokers, individuals who control 90% of the inventory in all these major markets. Okay. It's not like in single family where there's like in Phoenix hundreds or thousands of real estate agents and anybody can get a license. These brokers, they control the market because they've all been doing it for several years, 10, 20 years, and they have relationships, with all the big private equity firms and things like that. So if you want to
Mm-hmm.
break into the space from our perspective as an operator, not from a passive investor, but what we do is we had to build these relationships, and it took several years to build these relationships with the brokers, earn their trust and credibility so that we can get off market deals that other people don't see. Okay. So this is not the same as just throwing a single family home on the MLS and anybody can come in. I mean, there are deals that get marketed, right? But there's a lot of deals, and the majority of deals that we've bought are off market where other people have not seen them. And it's because most of our sellers that we're buying deals from are large institutions or private equity companies, hedge funds, life insurance companies, and they want the highest probability of execution. A lot of them also want privacy. And so what I've done over the years is build relationships with these real estate brokers. And so I started in Phoenix and built these relationships with the top handful of brokers and kind of prove that we can execute and do what we say we're going to do and close on these new acquisitions of apartment buildings. And then they start to feed you these off market deals that other people don't see that are really the better deals. And by the way, just because it's off market doesn't mean it's a good deal. Okay. But if you can have a lot less competition, it just improves your chances. And it's a needle in a haystack. Okay. So we're constantly
Mhm.
underwriting deals, meaning that we're evaluating them. And it's a 2 to 3% hit rate, meaning that for every 100 deals we look at, maybe 2 or 3% of them, 2 or 3 of them make sense in our model to buy. And so, we did that in Phoenix and got established. And then, once we had that credibility, we were able to call the guys in Phoenix and say, hey, we're going to Dallas. Can you introduce me to your top colleagues in Dallas? And so
Mhm.
they endorsed us and immediately started getting off market deal flow in Dallas. We did the same thing going to North Carolina. Okay. We called the Dallas and the Phoenix brokers because in this space, these are the same large firms. These are the same large brokerage firms have a presence in all the major markets. So the
Right.
same companies, the same guys I was talking to in Phoenix, they refer me to their colleague at the same company in Dallas and North
Mm.
Carolina. And that just
Mhm.
allowed us to kind of break in and get really a competitive advantage. And so you hear a lot of people in this space, Madhvi, say that it's a quote unquote, it's an unfair game. Okay. It's not,
Right.
it's not as fair. It's really based on relationships, credibility, track record. Can you perform? And if you can, you're going to see a lot of opportunities that most people don't see. And so as a passive investor, you don't have to worry about any of that. You're basically investing with a sponsor or an operator who is doing everything from A to Z, from sourcing the deal to acquiring it to operating it and then selling it. I'm sure we'll get into some of that, Madhvi, but that's kind of what the acquisitions front looks like.
I love that, Zach, and it's so important. Passive investors, they're kind of multiple layer removed from this. Building the relationship portion that you just mentioned about, right? This is not just pick your call and create that relationship and talk for half an hour kind of relationship, or pick that investment from listing from internet. This is much more beyond that, and this is not just even taking them out for dinner or something. This is actually genuinely being interested in these people, and that's where you're really, it's not just a business, it's a personal relationship that you're building, and that's why they are referring to their colleagues. And there's certain protocol in this industry that you need to maintain and you need to follow. Otherwise, once you get red flag, you're kind of red flag. So as passive investors, you're thinking that, hey, I love the multifamily, how difficult it could be, purchase a bigger property, 5 to 50 units, and put a maintenance crew person there, put an operational person there, and they're just going to manage it for you. No, this is not. This acquisitions like just mentioned, it's
Yeah.
so difficult to even find the right deal. If it is not the right deal, and you find that you acquire that, you are going to inherit ton of problems with that, right? So
Yep.
let's talk a little further more into acquisitions, Zach. And again, this is your expertise. Let's talk about the markets. There there are a ton of cities, really. I mean, there are a ton of cities across US. Why these three cities? I mean, you kind of indicated a little bit about the criteria why going into it. So let's take city by city and dissect it, right? When it comes to, let's start with your first market. Why did you go into that particular market? And what are the advantage and disadvantage, and why do you still continue to be interested in that? And we'll go to Dallas, and then we'll go to Charlotte after that.
Sure. Yeah. Great question, Madhvi. So, yeah, I started this in the beginning of 2018. And, I know in the beginning we said, hey, you don't always necessarily want to start investing in your home market. Well, I was lucky and fortunate, Madhvi, that Phoenix was a very strong multifamily market. And that's where I was born
Yep.
and raised, right? So for
Yeah.
me, I had the benefit of it being one of the top multifamily markets in the country for what we do. And I knew the area, right? And I was
Mm.
local. And so that just made perfect sense, for me to start in Phoenix. And again, it was top five for job growth, population growth, rental growth, diversified employment, things like that. And so
Right.
that's really where we built the infrastructure and started the company from the investment side. We started the property management company, became vertically integrated. So we manage everything in house. We started the construction company, and we bought our first 40 properties in Phoenix. And we have thousands of investors. Okay. A lot of them are repeat investors. And for a couple of years, we had investors saying, hey, we like what you guys are doing. We like the business plan, but I've
Right.
invested in like 10 deals with you in Phoenix. I want to be diversified into different markets. And we were telling them, hey, we understand, but we are trying to make sure that we build out our supply chain, our operations, all of our systems and processes so that we can confidently replicate it in another market. And once we can do that, then we'll expand. And so near the end of 2022, we felt good about that. And that's when we went to Dallas and we replicated that
Mhm.
same model. So that's kind of why we started in Phoenix. And we still love Phoenix. We have not bought a deal in Phoenix in over a year. And that's because
Mhm.
there's hardly any deal flow. There's just not a lot of inventory. Not a lot of people are selling right now.
Right.
We haven't sold a deal since July of 2022. It's been 2 years now. So we sold 5 deals in the first half of 2022. They were all home runs for investors. Then as
Right.
interest rates started to skyrocket, value started going down. And we told investors, we're not going to sell these deals and give buyers a discount because of interest rates. So the last couple of years has been a great time to buy new deals, but it's not a great time to sell deals because you're not
Mm.
getting very good value. So in Phoenix, there just hasn't been a lot of distress, and there hasn't been a lot of opportunities to buy. So we are still looking. I mean, we're still getting deals sent to us every week from brokers, underwriting them. We just haven't been able to find anything.
Thank you. Thank you for sharing that. So let's talk about, Dallas market a little bit. Of course, Phoenix has its own challenges, and we will talk a little bit about those challenges and how you're managing it in a bit. But let's talk about Dallas market. Why did you select the Dallas market? And as you can see that, even I quite frequently do see a lot of deals in Dallas, right? Dallas just feels like this whole big gigantic city which is just taking all these different type of properties and investments, and people are just flooding there. Why is so? What's so peculiar about Dallas?
Yeah, and so we looked at every major market, Madvi, in the country, and Dallas just checked all the boxes. And by the way, I mean our personal preference is we don't like any other Texas market really. Like we don't really like Houston, San Antonio, or Austin for different reasons.
Aw.
Sorry, nothing personal, Mavi. I mean,
I know,
you're
I
the
know.
only reason we
Well,
would consider Austin. Yeah, because you would.
no, I actually discourage my investors too. So, I'm
There you
just
go.
kidding.
I know. But yeah, Dallas, Fort Worth, I mean, a lot of the same reasons, Mobby. We like the job growth. I mean, they call it the headquarters of headquarters. All these major,
Mm,
national companies have their headquarters there, population growth. So Dallas, Fort Worth, like you said, is just a beast. It's a machine of people, jobs, really strong economy, and it's really good for multifamily. And there's a lot of 1980s vintage apartment buildings product that we like to focus on. There's a lot of inventory there where it makes sense. And it wasn't too far, it's like a 2 hour flight from Phoenix. And so for our first market expansion, we said, hey, this makes a lot of sense because we have the same supply chain here, with all of our materials, the same cost, the same
right.
process, and we can just execute the exact same plan here. So it was a great first market to expand into, and it really just allowed us to replicate what we were already doing.
I love that, love that. And now, congratulations, you added a city. I think you have closed 3 deals in this new city, and that's your new city, which is Charlotte. So let's talk about, your move from Phoenix to from, Dallas to now expanding into Charlotte.
Yeah, so we moved to Dallas near the end of 2022, and that gave us kind of a blueprint for how to open up a new market, Madvi, because we
Mm-hmm.
learned what it takes for like office staffing, local operational staff. What can we, keep at the corporate level in Phoenix, and what do we need in that local market? And we talked about the supply chain. And so we were looking for a third market. Okay, so we started to grow in Dallas. We bought almost 3,000 units there, and we still love Dallas and Phoenix. Well, I told you we can't really find deals in Phoenix right now. And we had a lot of
Mm-hmm.
investors saying, hey, I've invested in a bunch of these Dallas deals. We want diversification. And so, we had always wanted to go to the Carolinas because we knew it was a strong market. And we were looking at the data. We looked at every single market in the country again. Okay. So we looked at Atlanta. We looked at all of the Florida markets. We were looking at, Vegas, all these different markets. And it really came down to Tampa and Charlotte.
Mm-hmm.
And we chose Charlotte because Tampa, just has really high insurance costs. It makes the economics hard to make sense. And
Makes
I
sense.
think we will expand there in the future, when things settle down with insurance and we can figure that
Sure.
out. But we were surprised, Mavi, that North Carolina at the time of this recording was number 3 in the country for new population growth. So
Hmm.
number 1 is Texas, number 2 is Florida, and number 3 is North Carolina. And so we
Right.
looked at Charlotte. It had really strong median income, really affordable rents. And when I say Charlotte, we like Charlotte. We also like what's called the Research Triangle, which is like Raleigh, Durham, Chapel Hill area, about
Mm-hmm.
2 hours east of Charlotte, 2.5 hours east. So we're looking in those two major metros. And I always tell people too, Madhvi, is that part of our philosophy is that we want to be in the heart of major markets. Okay, we don't want to be in some small tertiary market. And
Mm-hmm.
some people like to do that, and that's fine. Okay, this is our strategy.
Strategy, yeah.
I don't want to be in a smaller market. I'd rather be in the heart of a large city. I'll pay a little bit higher price per door, a lower cap rate,
Mm-hmm.
knowing that there's really strong infrastructure of jobs, population growth. So I feel more insulated during an economic downturn. And then when you have those strong economic times, you can experience that explosive growth. And so, Charlotte and the Research Triangle of North Carolina really checked all those boxes. And again, that's only a 2 hour flight from Dallas. And so
Yeah.
we opened up an office in Charlotte here in 2024. We actually had a few local Phoenix staff that voluntarily wanted to relocate to Charlotte.
Mm-hmm.
And some of them
Mm-hmm.
already had family there. Some of them wanted to move there. So we had trusted people that had already been with us from like an HR role, an operations role, a construction role, and our supplier has local warehouses there. So again, it's basically just rinse and repeat that same business plan now in a third market. So we've got diversification for our investors, the West Coast, Arizona, Central in Dallas, and East Coast in North Carolina.
Love that, love that. And that's very important, again, as passive investors, look at how many different factors that go in, when it comes to Charlotte, when it comes to Dallas, when it comes to Phoenix, that diversification of employers that, Zach is talking about, that's really, really important. And just, having this like prime market, these top cities that being worked on, it's not only important when you're moving in, but it's also important when you're moving out. When you want to
Yep.
exit these
Right.
properties, you want buyers to bid for these properties. You want buyers to be lined up, right? So that's
Yep.
again an important aspect. So thanks for throwing that light on it. The next part I would love to talk about from the investor perspective is that somebody who's thinking that, okay, I'm just going to get my friends together and five of us, we're going to divide responsibilities, and one is going to take care of acquisition, one is going to take care of this underwriting, one is going to take care of the operations. Let's talk about the operations.
Yeah.
It's not as easy as we see, right? It's not
Yeah.
just, hey,
Oh,
put a maintenance person there, put a property management there. We all have been in an apartments, we all see that they're managing it, but there's so many things that under the carpet, right? The problems are, sustaining these employers or just the staff members, even from their turnaround or managing the problems or anything. So let's talk about, the operations. And this is actually a right time to talk about your vertical integration too.
yeah.
Did you start vertically integrated, and what are these problems that you face, and why did you started thinking about your own property management?
Yeah, great question, Mavi. I mean, we were those people. I was listening to the podcast and I thought, okay, I'm going to go buy an apartment deal. I'm going to slap a third party management company on there and I'm going to
Mm-hmm.
sit back and collect the cash and they'll do everything. And that's what we did on the first handful of deals. And the very first deal, a couple months into it, we immediately started having issues. Okay. And I'm not saying that you can't use third party management or groups that do it aren't doing it the right way. Everybody has a different experience, but we used three different property management companies. And what we found is that they were not staying on schedule or on budget for the renovations. There were issues with staffing where we didn't have full control. So we never planned to start a property management company when we got into it. We did it out of necessity because we realized, hey, if I'm going to take investor capital, I owe it to them to do the very best that I can do. And they're not going to care if I make up an excuse and say, "Oh, the property management company didn't do a good job. That's why I didn't execute on this business plan." And
Right.
so we started our own company, our own property management company, so that we could have full control. And there's a couple different reasons. I mean, one is that somebody's not performing, I need to fire them. Then I need to do that. When you have a third party management company, we had people that weren't performing and they would not get rid of them, and
Mm.
ultimately, we don't have control over that employee, that staff. And so we couldn't do anything about it, which is crazy when you think about, the fact that you are the one owning the asset. And so, we needed that control. And after COVID, it was very competitive for labor across the country, across
Right.
multiple industries, but a lot of people didn't want to work. They're getting stimulus checks. And so it started to make wages go up because the good people
Mm.
did want to make more money. And so what we did is we started our own company and we gave very competitive compensation and healthcare benefits, the most competitive in the industry that we're aware of, to not only recruit the best people, but to retain the best people. Okay. So we're covering 100% of all of our employees, medical, dental, vision, 50% of their dependents. We have a 401k program. We match 3%. This allowed us to
Wow.
poach the best talent from other companies and
Mm-hmm.
find people who are, incentivized and they're elite at what they do. So we then in turn get better performance at the asset level. And so, yeah, I mean, that was, we really started out of necessity and we said, okay, this is the way to go. This is how we can build a truly, built out private equity firm for the long haul. We started a construction management company. We started to buy all of our materials directly wholesale so that we had full control over our supply chain. We can control our cost. We wouldn't be vulnerable to macro
Right.
supply chain issues. And so, those three verticals made a huge difference for us to be able to execute these business plans and operate the way we were supposed to.
Thank you for sharing that, Zach. I did not know that you offer so many benefits. It's almost like a corporate level, right? And you're
Yep.
right. It's the vision is like the private equity firm. It's not just one or two syndications that you want to do. And somebody who wants to get into syndications and just do it as a part-time job and build the passive kind of income. If you're not into this 100%, let's just look at these challenges that Zach just talked about during COVID time. If when you have such a turnaround, ratio for your staff, and say your property management leaves, what are you gonna do? Are you gonna go and start doing that property management yourself there? So having this, bigger infrastructure and to even start with the vision, it's really important to have that scalability, right? So Zach, I mean, you can't just have a property management company vertically integrated, the three kind of pillars that you have when you have two properties or three properties. Where is that scalability really makes sense?
Yeah.
In how many properties really?
Yeah, no, it's a good question, Mavi. You can't, it's hard to just start out with it because it doesn't make sense economically.
Mm-hmm.
And so, we did it right around 2000 units. Okay. And we were kind of planning it out, and around 2000 units, it started to make sense. And, it took us about 10 months for that company to break even. So we spent about 800K that we invested into it, with
Right.
salaries, all the different stuff and I tell people that are in the space, a lot of syndicators that use third-party PM companies, they think they're running a company. And I tell people, and I'm not trying to sound arrogant, but when I tell people you haven't started a real company until you started a property management company, because then you get everything that comes with having an actual organization, like all the HR and a lot of staff and,
Mm.
payroll and, all the issues that come with it and all the challenges. And so it is building a real organization when you start to do that. And so yeah, I mean that's kind of how we did it. I think around 2000 units starts to make sense. Because when you're smaller, a lot of groups you do have to start out with third party because you just don't have the capital or the revenue to support that.
Mm-hmm. Yeah, you kind of have to invest into business to make more money, right?
Yeah,
It's
exactly.
incredible.
You're investing in a new
Yeah.
business. That's right.
Yeah, yeah. Wow, that's incredible. And it comes, I mean, PM is a lot of headache. I mean, it comes with a lot of headache. I'm sure you have your systems and processes that you're speaking of, and
Yeah,
training, because this is a very customer focused role. These are the
that's
people who
right.
are actually representing your brand in a true sense, sitting that
Yep.
at the department, right? So
Yeah.
incredible. Thanks for sharing
We have
that.
that's a good point, Mavi. Real quick, is we have in-house recruiting and in-house training staff. So
You do.
that's critical. I mean, you want to make sure you're finding the right people and vetting them according to your standards. And then when they start, they need to feel supported. They need to be trained on the property management software. And then we do ongoing training. I mean, the last couple of days, we hired a well-renowned sales trainer, and he's been in our office
Mm,
the last 2 days. And
right.
he did sales training on all of our leasing agents and all of our on-site managers and assistant managers to help them learn how to close the sale, close the
Mm,
lease. And so these are the things that we do that are different. And most of these third-party property management companies, I tell people, Madvi, property management is a crappy business model. Okay. It's very low profit margin. And so
right.
when that is your business model, if you're a third-party management company, and that is your focus, then you have to cut costs in order to make your business profitable. For us, we're not trying to make money off the property management company. Okay, we make
Mm-hmm.
money off of our investment company by getting good results for
Mm,
investors. That's our high profit margin business. The
right.
management company is profitable for us, but we just need to break even. So we're spending a lot more money into infrastructure, into our staff, different perks, bonuses, things like that to get better results. And when you have third party, you have to just understand the way that their business is structured, they're not going to do all that extra stuff. So that's kind of the difference that we've seen too.
Thanks for sharing that distinction. That's really important, right? Because your main model is that investment, right? So,
Yeah.
I'm just looking at it at kind of an eagle's eye perspective, Zach, and I'm looking at this, you focus on investors and their well-being and what's right for them. You're looking at your staff. That's another people portion. Let's talk about the
Yeah.
third people portion, which is the driver for everything that drives, and that's the people who are staying there, that tenants that are there, right? And a lot of times multifamily syndicators get a bad rep saying that, hey, they're just coming in, they're just pushing the rents, and they're just misusing that ability, right? But
Yeah.
there is so much more to it, right? And I know that, and I have visited personally your properties after you kind of have acquired them, right? You have, first thing that you start implementing is making sure that the facilities, when it comes to that clubhouse room or something, that you start renovating that. And I was talking to one of your staff member that why is so, and it's like, oh, they're just so good at, or it's important for them to run this resident events and programs, right?
Yeah.
So let's talk about those residents there, that what is it that Rise 48 brings as a distinction for residents? How do they make this place a better place to be?
Yep. No, great question, Mavi. And yeah, so you're exactly right. I mean, every business has a customer, right? Or a client. And
Mm-hmm.
an investment company like this, we have two types of clients. We have our investors, obviously, as our customer, and we have our residents, for our assets. And so we want to make sure the residents have a good experience because in this day and age, I mean, it's the right thing to do, obviously, and word spreads. But in this day and age with internet, social media, your reviews and reputation are everything, right? And so we want to make sure that these residents are having a good experience. So we invest a lot of money at the property management level into community events, holiday events, different things like that, raffling off gift cards. We just finished our Rise Supplies event, where
Mm-hmm.
basically, we spend thousands of dollars at the corporate level in order to provide school supplies for all of our residents at every single asset. Okay,
Nice.
so we basically give them, backpacks, all of their, pencils, pens, all their supplies, things like that.
Really.
And that goes a long way. We've been doing that for 3 years now, where we do the Rise
Mm.
Supplies event. And so I'm actually going to one of the properties next week, and we're still doing it. We just finished it in Dallas, and we're doing it in Phoenix because school is about to come back in session. And so, residents appreciate that. And we do like, we have food there, we have ice cream, face painting, for the kids, things like that. So those are the big important things, obviously, is you want to build a sense of community. And we brand all of our properties Rise something, right? Rise
Mm-hmm.
McClintock or whatever it's called. And so you start to generate a reputation within that community. And we've had residents that have literally said, hey, I got to move from West Phoenix to East Phoenix. I got a new job, but I want to live at a Rise property. Do you guys have anything available? And
Right.
they'll sign a lease at one of our other properties because we have that, right? We
Love
also
that.
offer, yeah, we offer like referral incentives for residents if they want to refer their friends or family, they can get like some type of discount on the lease. And so those are really important. And yeah, to your point, Madhvi, right when we take over an asset, our primary focus is to improve the amenities, okay, and the exterior
Mm-hmm.
paint. We want to make the asset look cleaner, nicer, more modern, so the residents see, because the residents know when there's a new owner, right? We are required by
Mm-hmm.
law. We have to give them notices. Hey, there's a new owner, a new management company in place, and we want to show them that we're here to improve their experience. So whatever it was before, whether it was good or bad, we want to make it even better. Okay. And so we'll knock out exterior paint typically in the first 8 to 12 weeks. We get new signage, we do new landscaping. So we'll trim all the trees, make the asset look nicer. Like you said, we'll start renovating the clubhouse, the leasing office, the fitness center, the playground. So we want to make sure that these residents see right away, okay, these guys are actually improving, this asset. And if there's some residents that we've bought some assets in the past where you've got some like crime issues, and we've learned our lesson in the last few years not to buy in those areas. But there was one property I remember that there were drug dealers at the property, and we got
Oh,
them out immediately. We hired off-duty police. to patrol. We
Mm.
got them out, and we had a family come to us and say, "Hey, I've lived here for years, and I love everything you guys are doing. Thank you so much." And they actually said they were happy to pay more money for a renovated unit because it's nicer, the amenities are all new, they feel safer. And so, yeah, I mean, we truly are improving these communities. I mean, it sounds like a cliche, like what a politician would say, but it's true. I
Right.
mean, if you look at the before and after photos, every single deal we've bought, it's a lot better than when we bought it. And so people see that and they recognize that. And so, yeah, that is a big component of it.
You do talk about a very, very important aspect here, Zach, and that's the safety, right? When you're renovating and you kind of completely making this facelift of this community, this place that they call home, right?
Right.
One of the unfortunate things, and which is kind of becoming a reality of our country, is that home affordability in this workforce housing, people who are working at the Starbucks or Walmarts, their affordability has become an issue. They probably would never be able to afford buying a home in this country with the
Right.
interest rates high, with the skyrocketing prices. Everything is just coming in the opposite direction and taking them further and further away from the
Yeah.
home ownership. So when they actually have this facelift of the community that they are staying in, not just outside but inside also, probably they will never own a home. But when you come and I really like to, and we'll talk about your platinum finishes. It's not a lipstick kind of a flip that just gonna put some paint in, just put some standard appliances in it, but you literally bring it up. They have quartz countertops, they have stainless steel appliances, they have wood look flooring, and inside when they come in it looks like a brand new home that probably they could stay in without being the cost of the home. So you're improving their the living environment, making that community feel by having these events, and kind of making them feel like home inside and outside. And then the safety for their kids, for their family, if they're going to grow there, feeling of safety. And when a building goes from this dull and outdated look to suddenly the white and blues that you have, the uplifted color and rebranding, suddenly this place becomes more safer. The motion sensor light,
Yeah.
for example, such a small thing, but it adds to their safety. So thank you so much for sharing
Yeah.
on that
That's
note.
true.
So let's talk about with that your construction. What is it, that distinction? And I was actually personally very thrilled to see how you kind of had made it like a machine, right? Whether it comes to Phoenix, whether it comes to Dallas, whether it comes
Yeah.
to Charlotte, you have the same kind of blueprint, just use it in different places. So let's talk about, and I think that's an important distinction for you too.
Yeah, great question, Madhvi. And so, yeah, I mean, again, that came out of necessity. I mean, I think most people that are doing value add deals, they're relying on the third party property management company to run all of the construction management, which basically means that you are sourcing, bidding out, and managing, vendors and third party vendors. So, right. So you're acting
Mm-hmm.
like a general contractor. And so we realize, okay, these groups, they're not staying on schedule or on budget with the renovation plan. We don't have control. We need to take this in-house. And so we started
Mm-hmm.
Rise 48 Construction. We have our own general contractor's license. And
Nice.
basically, it's really two-part. It's the construction management and it's the supply chain. And so we source and purchase all of our own materials for the interior renovations directly wholesale from an overseas manufacturer. So you mentioned
Mm-hmm.
kind of some of the finishes, Molly, that we do. We do a very high level class A luxury interior scope. Like you said,
Mm-hmm.
most groups are doing what you would call lipstick on a pig. And when we started the first couple of years, Monty, we did that too. And
Mm-hmm.
what I mean by lipstick on a pig is you'll resurface the original countertops.
Mm-hmm.
You will paint the original cabinets. Maybe you'll put black appliances in instead of white. The reason you do that, people do that instead of a higher level scope, is because it's too expensive to do a higher level scope to get the rental increase that you need. It doesn't make sense economically. Okay. And so
Mm-hmm.
once we started to grow and we sourced our materials directly overseas, we got significant discounts, wholesale pricing on these finishes, which allowed us to start doing stainless steel appliances instead of black appliances. Instead of painting the original cabinets, we rip them out and we put in brand new cabinet boxes with brand new shaker doors and brand new hardware. Instead of
Mm-hmm.
resurfacing old Formica countertops, we rip them out and we put in quartz countertops with undermount sinks and modern plumbing pull down fixtures. We do subway tile backsplash. We do
Wow.
LED lighting package. So yeah, it looks like literally we rip everything out of the unit and we make it a brand new Class A unit. And we can
Mm,
do that because we have so much buying power and scale to get cheaper prices, right? And so part of that is part of the construction company is having that supply chain. And then also our W-2 employees are the ones that are walking these units 40 hours a week, making sure
mm,
everything is staying on schedule and on budget. So we're not relying on a third party of a third party of a third party. You know, you get all these
right.
subcontractors. And so if somebody doesn't perform, we just fire them, right? And we have
Mm,
fixed contracts with our material provider. So we get locked in pricing on our materials. We'll use third party labor to actually do the in-unit labor, but my guys are on site monitoring them and supervising
monitoring.
them 40 hours a week. And so we have fixed pricing with the labor, and we require that the labor uses our materials. So they can't mark
Hmm.
us up on materials if they're providing, which is what most people do. And so that's allowed us to kind of have this blueprint where we can rinse and repeat the same exact plan. We've renovated thousands and thousands of units over the years, all to this same scope, and we've stayed on budget because of that. So that just kind of allows us to scale to different markets.
Amazing. So, how many units did you renovate last year, just out of curiosity?
Yeah. So last year was a big push because we were trying to fight back against all those interest rates that
Hmm.
shot up in 2022. So in 2023, we renovated 1,923 units. So just under 2,000 units
Nice.
in 2023 alone. And our infrastructure of having the property management, the construction management, supply chain, that was really the reason why we've been able to continue to grow through this tough environment the last 2 years with interest rates. Whereas most people have
Mm,
capital calls or losing investor money, we've never done a capital call. And it's because we were able to renovate, force appreciation, increase the revenue at these assets to fight back against these interest rates and reposition assets. And so that's kind of been, a big advantage that we've had operationally.
yeah, let's talk about that. In fact, that was going to be my next question, because the expertise that lies with the syndication team is not just the expertise of what you just talked about, right? From acquisitions to kind of operations and exit, right? The
Yeah.
expertise is about when the market throws you a curveball, how do you treat that curveball and how do you play that along, right? So how you manage the challenges is the most important aspect of it. So, take us a little bit deeper into how did you manage these challenges in last, a year or plus, probably 18 months. How did you manage that? Because not only the interest rates are going high and it is unprecedented, right? Nobody had a crystal ball. Nobody saw that coming, right? On
Right.
that side. And then there was so much supply. There was a push of the supply, and then you have to push down probably your concessions and stuff like that. And then the rent growth, which was, again going up, and it almost goes up with inflation. So it in some of the areas there was this, 12 to 15% even annual rent growth. And
Right.
that actually turned it face down and started going negative. Like Phoenix is one of those markets, right? How
Yeah.
did you navigate this challenge? And that's again the expertise of the syndication team, the kind of the demeanor that, I'm sure it was very stressful, but
Yeah.
kind of coming back to that demeanor and kind of taking those right decisions for your investors. Uh,
Yeah, great question. Great question, Bobby. Yeah, I mean, you had multiple challenges the last really 2.5 years now. It's almost been, 30 months now since the Fed started
yeah,
increasing rates. So yeah, you
yeah.
had interest rates skyrocket. You had all this new supply of apartments that came online in end of 22 and throughout 2023 and all the Sun Belt markets, right? Because there people were building from 2019 to 2021, and then all that new supply flooded the market. At the same time, in 2023, you had a lot of those COVID stimulus checks. People don't realize that a lot of these residents and tenants were getting COVID stimulus checks, and they
Mm,
all stopped in 2023. Okay,
mm,
so and then you had inflation catch up to these residents where their groceries, their gas expenses are just so expensive, people can't afford the rents. And so in all these major Sun Belt markets, you had really strong organic rent growth go negative, right? So in Phoenix, it was 10 to 20% each year the few years prior to 2022, and it goes to negative 4% in 2023. Dallas was
yeah.
negative 1% in 2023,
Mm-hmm,
trailing 12. And so basically, if you were not renovating units and pushing your rents are going backwards, right? So
mm,
we renovated over 1,900 units in 2023. Our average rental increase was $453 per unit, and that was $20 above our initial projections. And to be
mm,
honest, we were not assuming in our initial projections that we'd have negative 4% rent growth in
right.
2023. Nobody saw that coming, right? And so the ability to force the appreciation by renovating units and having the infrastructure to actually execute that plan, it allowed us to, kind of weather the storm because we weren't
Mm.
vulnerable to just relying on organic rent growth or organic appreciation. The reality is that the 5 years or so prior to 2022, anybody could buy a deal, call it quote unquote value add, do nothing, and
Mm.
organic rent growth takes off, cap rates compress, you sell it, and you look like a genius, right? And,
Yep.
and we benefited from that too. It helped to juice our returns, but we also had created infrastructure to actually renovate units, actually increase net operating income. And that's kind of been, the saving grace for us to not have to do a capital call, to preserve investor capital. And it's put us in a position where most people have been on defense the last couple of years.
Mm-hmm.
We've been on defense as far as making sure that our portfolio was in a good spot and renovating, but we also have been on offense because investors see that. And we have investors that invest, they're sophisticated people, they invest with a lot of different operators. So they kind of see the difference of which operators are performing, what decisions are they making, versus the ones that are not doing so well. And so, since September of 22, we've purchased 18 deals, 1,000
Mm.
units. We've continued to grow. We've added 2 new markets, and it's kind of because of that approach, I think, because investors see that.
Yeah, that's a really important distinction, Zach, because we have seen that the whole distress has kind of come to the market. Investors are getting capital calls. In worst case, they are also losing some of the capital too, right? We have seen those kind of articles as well coming in. So that's why it's really important. The team, I always say when it comes to due diligence, the team is the most important aspect of it, where you're putting your hard-earned money and what is the capability of that team in something happens, right? I mean, having deep pockets is also important, that you are able to kind of put some money in there so that that capital call is not necessary or is not happening, or just navigate these challenges in as many ways, different ways as possible, and continues to renovate these units, continue to have that rent bump, because it's not like the residents are going anywhere. It's not that they don't have jobs.
Right.
They have jobs, they're paying it. So the
Yep.
fundamentals of these properties are good. So if you are able to push that with the renovation, you are able to sustain. So kudos, great strategy. So with that, I'm just going to circle back to our original questions for our listener. And, before we go to the last two segments, and again, this conversation has lasted longer than I thought. Truly appreciate you being here, but we will have two more segments, and we'll try to do it quickly as well. But I'm going to wrap this, thread around our original question that, should I invest in the market around me, or if I do not have control, should I be going into multifamily syndication, or should I just purchase a multifamily unit and start operating with 4 or 5 of my friends, assigning different responsibilities? Just go back and look at this episode. Just listen to what Zach has said. You kind of have to think about getting off-market deals, those relationship. We talked about underwriting in our previous episode with Bikram. We talked about market selection. We talked about the operational challenges, the construction management, the property management, the vertical integration, the scalability of that, and above and beyond all that, the managing the challenges with something throws your curveball. That can only come from the experience and how you can approach these challenges very well. So Zach, great insight into it. With that, sadly we will go into towards the end of our today's episode. My next question is going to be for you and your personal kind of financial strategy. Are you ready for that?
Yeah, let's do it. Let's fire
Absolutely.
away.
Yeah, so when it comes to your personal strategy, right, one of the important aspect of think outside the stocks is we don't just like to talk about investment, but we'd like to kind of step back and talk about how to grow, preserve, protect, and pass your generational wealth, right? You are a new father. You have started. I mean, just before even becoming a father, you have this massive portfolio and massive achievement, which is really inspirational. First of all, inspire us by sharing with telling us, how do you, Zach, think outside the stocks? How do you manage your financial structure, make it safe, secure, so that it becomes kind of protected, estate
Yeah.
planning, etc.? How do you manage that?
Yeah, that's a great question, Madhvi. And I'll give context that, I don't come from money. So I grew up in like a lower middle class family. My dad was initially in construction. My mom was in like an HR person for a company. And then my dad became like a financial advisor, so just kind of like a mid-level financial advisor, nothing crazy. So I remember when I was in college and right after college, he encouraged me to get like a brokerage account so I could have money invested in mutual funds. So I
Mm.
did that, and I was reading all these finance books and trying to learn about different stuff, and I was just watching it, and I didn't like the fact that I had absolutely no control. I had a financial advisor just charging me fees. I had no visibility, transparency into all this stuff, right? And so I
Mm-hmm.
was like, what is the point of this? I just didn't feel like this is how I'm supposed to get rich, because I wanted to get rich, for lack of a better term. I wanted to become very
Right.
wealthy. Unlike my family, like that's what I wanted to do. My goal still is to become a billionaire, right? And so
Mm-hmm.
I was like, I'm not going to become a billionaire or even become financially free doing this. When I started learning about real estate, I pulled all my money out of the stock market, shut down the brokerage accounts, and my dad's still a financial advisor. I have no
Mm.
money in the stock market. I have the majority
Wow.
of my net worth in our portfolio, and
Mm-hmm.
majority of my cash in our portfolio, because I believe in it that much. And then I have money that's in like a high yield savings account and money market, right? So it's just like a
Mm.
liquid, it's effectively just a money market account or like a high yield savings account, so that it's liquid as well. But yeah, I mean, in the future, I'm sure I'll diversify a little bit more. But from my perspective, I consider myself very risk averse. And I just feel like, hey, I understand and believe in what we're doing with real estate and multifamily. And I think in the long run, it always ends up making sense. So that's where most of my money in net worth is. And then I have liquid cash, obviously. We have to meet liquidity requirements for these lenders, things like that.
Mm.
I have
Correct.
not invested in crypto or anything like that. I think fundamentally, I like the concept of Bitcoin, that it's decentralized. I just haven't really been able to wrap my head around investing in it. And so,
Right.
yeah, I'm pretty simple. It's pretty much, you know, cash, high yield savings accounts, and then real estate, hard assets.
Yeah, yeah, very risk averse. Thank you for sharing that. That helps a lot to know. Even person like you, how you're managing it. So with that, we have our last segment, which is going to be a quick segment. It's called Rapid Fire. I just asked 3 fun questions because we talked, oh my God, so much serious stuff, and which is very, very important to our listeners too. But the rapid fire just helps us alone kind of end on a fun note, kind of a lighter note. Are you ready for the rapid
I'm ready.
fire?
Let's rapid fire.
All right. So my first question is going to be, I mean, you come from your background as a football player. You got scholarship to go to school as well, right?
Yeah.
So when it comes to the games, is do you still play? Do you still have time now that you're a parent? Now you have this big huge business, or just share with us one of the most memorable moment when in your playing days.
Yeah, absolutely. Yeah. So yeah, I've always been, big into sports and an athlete. And so I played high school football, college football. I wasn't good enough or big enough to go to the NFL, so it stopped
You
stopped in.
could be.
Yeah, I know. But yeah, so I mean, yeah, I mean, honestly, so I don't still play, but I still watch football. I've definitely watched less the last few years just because I can't like sit on the couch for like 3 or 4 hours. But I'm a big Denver Broncos fan, and
Mm,
my dad like raised me as a Broncos fan, and so when the Broncos went to their last 2 Super Bowls, actually, and this
mm.
is before we started the real estate company, so I spent all the money I had and I took my dad to those 2 Super Bowls.
Oh my
Pretty
God.
cool. Yeah, it was like I got like the nosebleed seats. It was like $2,500 each. So I spent like $5,000 on tickets, and I took him to those. So those are really memorable. I mean, the most memorable moment was the Broncos beat the Panthers. Was Peyton Manning that game? That was pretty cool. So that, yeah, still a huge sports fan, just not as able to spend as much time on it.
Love that. Thank you so much for sharing that. Wow, the nosebleed seats.
I
Did you
know.
get nosebleed? Just
Yeah,
kidding.
yeah. It was bleeding the whole time. I'm just kidding. Yeah.
Wow, I would love that. Just and then my second question is going to be just understanding as a person, right? I mean, I'm sure that you love to travel, and you and your wife, and now your child. I'm not sure if you three of you travel together, but what is your favorite destination to travel so far, or what both of you, especially?
Yeah, good question. The funny thing is, Madhavi, I actually do not like to travel.
You
I
do
am
not.
No, I'm super like routine oriented and disciplined, and I don't like to travel because I
Oh my
I
gosh.
can't work out at my gym. I can't eat. I eat the same thing every day, every meal. I drink the same stuff every day, so it like gets me out of my routine. So I don't really like to travel, honestly. My wife loves Hawaii, And I tell her, I don't want to sound negative, but I think Hawaii is like the most overrated place in the world. 6 hour flight from Phoenix, and it's just like I don't get it. But yeah, but we did. So I do travel a lot for work, right? Because we have an
Mm-hmm.
office in a
You do.
house in Dallas. We have a second house in Dallas, and now we have an office in North Carolina. So literally just last week, I was traveling all week. I went to Charlotte for a few days, and I went to Dallas for a few days. And my wife did bring the baby to Dallas, so I saw them second half of the trip when they went to Dallas. So yeah, we travel a lot for that. I travel a good amount for conferences and stuff. But I mean, I even went to Europe 6, 7 years ago. Didn't really like it, honestly. So I'm not very exciting when it comes to that stuff. I just like to stay in my element.
That is interesting, and actually, that's good to know. This kind of segment served its purpose. We started
Yeah,
with fun facts, and actually, ending with the fun fact that you don't try. One of the few people that don't like to travel, and I
I'm
can
a boring
imagine
guy.
why.
I don't drink. I don't smoke. I just drink water,
Oh, I
coffee,
love
protein
that.
shakes. Yeah,
Love
that's
that.
it.
Love that. Thank you for sharing that. And my last question actually is going to be about you being a parent, right? So when you saw your son for the first time, just take us to that moment and
Yeah,
share that joy. What I mean, I know you cannot word it. Absolutely
yeah,
not. It's not fair to ask even for that question. But some moment, take us back into that moment and
yeah.
and share with us.
Absolutely. Yeah, no, it was super emotional for me. So we
Mm,
basically it was like 10 o'clock on a Sunday night, her water broke. And you don't know if the water broke or not, but you think it did. So you go to the hospital, and then we were there all Sunday night, all through Monday. And it wasn't until Monday at 9 p.m. that finally she starts to push and have him delivered. And then he comes out, and it was probably like an hour and a half labor. And then he comes out, and I just was started tearing up. You just get so emotional because you can't explain it. You know what I mean? It
wow.
just feels like a miracle. And it's a super cool feeling, and you're exhausted and all the emotions, right? You just
Right.
slept a night in a hospital, and then yeah, so we had to stay a second night, and you wake up, and when I woke up, I heard him crying, and you just realize because he was born at 9 p.m. on a Monday, so you wake up,
Right.
and she's with him all night, but I was sleeping like in the
Mm-hmm.
hospital room,
Right.
and and you wake up like that Tuesday morning, and it kind of hit me. I'm like, we have a baby now.
Oh my God, it's
And
giving me goosebumps.
yeah, and it's like this is like that's something that just happened yesterday, and then now today's a new day. Like you always will have that kid. You always have
Oh
that
my
child.
gosh.
It's just a cool thing, right? Because it's like your whole life does change. That
It
once he's
does. It
born, because
does.
like during the pregnancy, you're like anticipating it. Yeah, when it comes, great. But when he's born, it's like okay,
It's
this
there.
yeah, I joked with my wife Grace. I was like, okay, we were able to have him birthed, and now we got to keep him alive. I mean, that's next, right? Got to keep him alive. Make sure we do it the right thing. So,
Oh
yeah,
wow,
no, it's been
wow.
great. So,
No, that's incredible. It's kind of, brings back my memories of seeing my child for the first time. Wow.
yeah,
I was getting goosebumps as you're saying. So yeah, it is one of the most memorable moment, and you have it fresh. That's just beautiful. Yeah, the
yeah.
baby is not gonna go back in the tummy. It's just once
I
it's
know,
there,
right?
it's
Yeah,
there.
there's no
That's
receipt,
not dream.
right? Yeah, that's right.
I
Yeah,
love that. I'm sure you're great parents and can't see him, growing up as well. So I
yeah,
can't just wait for that. But again, thank you so much for this,
yeah,
beautiful golden tidbits and sharing the joys and sharing the stress. And we kind of had like a whole journey in itself in this episodes. I
yeah,
truly appreciate you being here, and hope to continue to work together as well. And I love that you are here. So grateful. Thank you so much for being here and helping us, our listeners, understand that it's not easy to be an operator, even at this massive portfolio. So thanks for sharing that.
yeah. Thanks so much, Mom. I really appreciate having me on. Thank you.
Thank you so much. And for listeners, and you got such a great kind of a wraparound of this strategy. And if you want to learn more about the passive investments in real estate syndications, we have a webinar that's either coming up or already happened by the time this episode gets relayed to you. But we are going to put the link to that passive power hour. Sign up for passive power hour and join our syndicated one-on 101 kind of a learning where to even get started with syndication team. And very frequently we have really highly vetted investments coming through. That's what we are passionate about. If you want to participate on these investments, there is going to be a form, invest with us, to join our insider club as well. I look forward to see you there. And thank you so much. We are grateful to listeners like you to listen to this episode, and when we have such great conversation with great guests like Zach. Zach, thank you so much again.
Thanks, Madhavi.
Thanks for tuning in to the Think Outside the Stocks podcast. If you enjoyed today's episode, please like and subscribe. Madhavi is on a mission to change the financial trajectory of one family at a time, with 1,000 more to go. We hope you'll be a part of this vision. Please join our growing community, and to get your journey started, visit thinkoutsidethestocks.com to download your free guide on active income with passive real estate investments. If you learned something new, please share it with one person today. And if you have 60 seconds, please leave us an Apple review to help us reach more people like you. Tune in for the next episode.